Hello and welcome to this weekly market recap for the week ending Wednesday, May 21st, 2025. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com. It's a pleasure to be with all of you again this week. We've had a market that's been really resilient of late. Not a whole lot to support the inflation argument still at this point. Not a whole lot to support the anyone thinking about a recession at this point. Certainly not a whole lot to support the stagflation talk that's been going on at this point. And so the market continues to move higher. And for the most part, it's been led by key aggressive areas, which to me makes the rally very sustainable. We are overbought. We do have issues, especially in the sentiment area. But otherwise, it's really hard to bet against a secular bull market. So we are getting a little bit of a pullback. We saw over the last few days, actually, some strength in areas outside of technology and consumer discretionary. So we saw a little bit of rotation here over the past 3 or 4 days, and the market's kind of been wobbling a little sideways and starting to maybe roll back over. But I would just be careful about how far I think that this market goes back down to the downside. I don't think it'll be nearly as steep as a lot of folks may believe. So first, let's go ahead and take a look at what happened or what's happened over the course of the past week in terms of our major indices. Nasdaq 100 down about 2/3 of 1%, Dow down 1% or just under 1%, S&P 500 a little more than 1%, Russell 2000 down 2.25%, S&P 400 mid cap down 2.37%. Then you got your transports, which had been showing some life, but the last week's been a little rough, and the transports have pulled back 3.4%. I will say that on the transports, even though on their absolute chart they were looking better, on a relative chart they do still continue to struggle relative to the S&P 500. So they're not leaders by any stretch in terms of the longer term, like weekly chart. So still a lot of work to be done there, but the improvement the last few weeks in transportation was certainly welcome by the bulls. Looking at the sectors, you can see on top over the course of last week is the consumer staple sector, defense, healthcare, which is defense. You can see communication services coming in there flat for the last week. But when you look for technology, consumer discretionary, even the financials, all of those are down here. And I've added the S&P 500 in here so that you can see what's been outperforming the S&P 500 versus what's been underperforming. And consumer discretionary and technology over the last week has been starting to show a little bit of deterioration on a relative basis. So that's why, I think the market is kind of wobbled and why we're getting a little bit of a pullback. But I would be careful again, assuming that this market's going to take too big of a hit. As I look at the chart on the S&P 500, you can see that we've had this huge move up. Here's where the S&P, like I said, has been wobbling. We've kind of rolled over a little, but we're still above the 20-day moving average. If you look at this PPO, at the most recent price high, we were also at a high on the PPO. So momentum is absolutely fully supporting this move to the upside, which normally, when that's the case, I look for rising 20-day EMA to provide great support. Right now, that 20-day EMA is sitting at 57.56, and today's low was 58.25. So we're only talking about another 70 points below today's low to get down to that 20-day moving average. And even before we get there, you can see that there is gap support. Top of gap support comes in just at about 5,800, maybe just a little above 5,800. And then the bottom of gap support would come in at about 56.70. I'd kind of watch that level if we fail to hold the 20-day moving average. But those are the three key support levels I see. And I think I have a chart where I annotate this, and I'll show you that in just a minute. The other thing I want to point out is that the AD line, accumulation distribution line, has continued to move higher. And even throughout the selling that we saw from February 19th down to the low on April 7th, the AD line pretty much just stayed flat. And as we started to turn back up here, AD line quickly moved back up to a new 52-week high. So this supports the theory that I talked about, that there was a lot of manipulation that took place back in early April. that there were a lot of gap downs and that there was a lot of selling at the opening bell and maybe even in the first half hour of trading. But after that, we saw a lot of buyers stepping back in. And to me, that represented Wall Street institutional buying. And I think as the markets just continue to rally back, that further confirms that Wall Street got what they needed. They got the shares they needed back when everyone was panicking out. But let's take a look at the other indices before we get moving on. Nasdaq 100, same thing, moving up, starting to roll over, but not doing too bad relative to the S&P 500. In fact, I would say it's continuing to outperform the S&P 500, and that's a good sign. But it's the configuration is very much the same. We've got the gap support, two levels of gap support that we need to watch, the rising 20-day moving average, which is now getting up close to that gap support. It's above the 20,500 level at 20,536. So, and again, AD line strong, PPO strong. I'm playing this, I'm trading this market as though we are in an advance in a secular bull market until the market tells me otherwise. I think it's a big mistake to always be bearish. I think the market went down. We saw a lot of rotation out of aggressive areas and into more defensive areas before the market went down. Market was preparing for it, and then we fell. Manipulation took place, and now we're back. And I would be very, very careful about assuming that we're going to go back down to that low. A lot of support levels before there, but I probably wouldn't even begin thinking about that until the gap support, the lower gap support, is lost on a closing basis. And at this point, we're still quite a bit above that level. Next chart, IWM. IWM I actually liked on this 20-day test today. So I got a little bit more aggressive personally when we hit this 20-day. We've got gap support that comes in just a little bit above the 200 level. We got down as low as 201.53. The 20-day is at 202.36, so we went below the 20-day, and now we bounced off of it. And with that PPO rising, that's exactly what I would have expected. I would have expected to see some strength. Now, this to me looks like a bottoming head and shoulder pattern. We got to get confirmation on a breakout above 210, but here coming down, this looks like a left shoulder, the left side of the neckline. Early April forms the reverse head. We come back up. We have a slightly higher right side of the neckline. I like that upsloping look to that. And then coming down and putting in potentially a right shoulder that also is upsloping relative to the left shoulder and testing that 20-day moving average. So the only thing left in this bullish pattern for me is a breakout above 210. And if we get it, that would measure up to about probably about close to 250, 248, something like that. You can see the prior high was near 245. So I kind of feel like if we break out above 210, we're going to have the small caps running back to the high at 245. A little early to make that call, obviously. We haven't made the breakout. This is the most aggressive time to get in, though, in the right shoulder, in that reverse right shoulder. If it breaks down, I mean, you could set your stop at the 50-day moving average. You can give it a little bit more room if you want. But I would think the 50-day moving average would certainly make me a little bit more nervous about the pattern, because at that point, not only are you going back down and clearing your two key support levels in terms of moving averages, but you also would be losing the left shoulder support. And you really, again, I like to see the upsloping neckline and the upsloping shoulders. To me, it just gives it more bullish feel. And then when you actually break out, you're breaking out above some very, very critical levels. The problem with a downsloping neckline, let's say we had come up to about 205 and then started to pull back. The problem with that would have been that when you break through the neckline at 205, you still have the left side of the neckline over at 210. You haven't cleared that yet. So I tend to be a little bit more bullish about this pattern when we've got the upsloping, which we do have right now. Last thing I wanted to point out here was the transports. Here was the absolute breakout. We do have an upsloping neckline pulling back. So far, we do have an upsloping right shoulder. And we've also got a kick save at gap support and the 20-day moving average. So transports were bad last week, but if this market is bullish, as I believe it is, This is a group that could easily move back up and take out that neckline and be back off to the races to the upside, maybe make up some ground on the major indices. Next up, here's where I have the support levels in on the S&P 500. So you can see there's the top of gap support. Here's the bottom of gap support. There's your rising 20-day moving average in between the two. But the one thing I wanted to point out here is, and this is probably still maybe my biggest concern short term, something that maybe keeps me up at night, is the fact that we've had so many options traders trading calls. So there's a lot of complacency in the market, and we know what happens when we get complacent. You can see back here in January, that low level right there where we got down to a 5-day moving average of about 0.485. That coincided with the January top, which was essentially the top. We did go up just slightly higher on February 19th, but essentially that was the top. That's when we started trying to think of the Chinese firm, DeepSeek. I think it was DeepSeek. That was when the news came out there. A week later, I think that was tariff news. So we had two gap downs, came back up and had one last attempt at a high, and then down we went. And all this period right in here, December, January, February, this was a lot of rotation. A lot of money rotating away from technology, away from consumer discretionary, away from communication services, and into defensive areas of the market. That's not a good sign when you're setting an all-time high. So that led to me personally being in cash and telling Earnings Beats members to be very, very cautious. Also mentioned it on my shows as well. And then the market went down, talked about the manipulation at the bottom. Now you see where we are. I believe we've got this uptrend in play. And again, watch these support levels. Unless all these support levels go, I'm going to continue to treat this as though we are in a secular bull market advance. But short term, we did get a little bit complacent. We're starting to come off of that a little bit. And sometimes, these complacent readings that we get down below this red line, I think any 5-day moving average of the equity only put call ratio that drops below 0.55 is one that I want to be careful in the market. And so you'll see a lot of these tops like this one coinciding with this low reading. Here was one with this reading. Right here, this little top was with this reading. There was just like a 3 or 4 months worth of complacency that was also becoming a problem, along with the rotation that was taking place. We had some divergences that weren't looking very good. There was a lot of different reasons that all came together. Here, I've got sentiment issues, but I don't have the same issues that I was having back then. I now have bullish rotation. We've had technology and discretionary lead this advance back to the upside. That's completely different than what we saw back in February. So, if you're looking at some of these signals and you say, well, we topped then that's only one signal. We don't have a lot of the corroborating signals that we had back then. And forget about the news. That's not corroborating information. That's lips moving. What I look for is what takes place on the charts. I'm always going to look at the charts and try to remain as objective as I can. I think I've stayed pretty objective, but it's still looking to me like we go higher with, of course, normal pullbacks. You're not going to go higher every single day, but I think in time we're going to new all-time highs. I don't think it's very far off. Take a look at I wanted to show you some areas of the market that are hot. I went over these a couple weeks ago, industry groups, because when I trade, normally I'm either going to trade the ETFs that track the major indices, maybe even the leveraged ETFs when I'm really bullish and I think we hit good key support levels. But if you're looking at individual stocks, what you really want to find are leading stocks in leading industry groups. And so I'm not going to pull all these up because I did that a couple weeks ago and they're mostly the same groups. But here's Aerospace, for instance. Now down the bottom, this bottom panel, this is the absolute chart on Aerospace. So you can see it had gone down in late March and then came roaring back. And in probably about the 3rd week of April, broke to a new high in the group. And Aerospace has been going up for a while, but their relative strength was pretty flat. But with this latest push, Aerospace is leading the market to the upside. This is one of the best performing areas of the market. So to me, it makes sense to, if I'm buying stocks when they pull back, why wouldn't I be interested in an aerospace stock that's been strong? I mean, not only has this group been good, but there are stocks within the group that are outperforming all of their aerospace peers. That's how you get leading stocks and leading industry groups. So I'm going to talk about this a little bit more in just a few minutes. I want to go over an RRG chart, and then we'll get into how I use information like this to start building a watch list of stocks that I'd be interested in trading. First, let's go over this RRG. So the RRG, this is just showing the groups. There are like 12 groups. I think I showed 12 a couple weeks ago, and just how they appear on the on this RRG chart. So right here, I'm kind of at the top. We're about the top, February 19th. There's the top on the S&P 500, and you can see most of these groups. They're aggressive groups, and most of them are either on the left side or they're moving into the weakening quadrant. And that's why, while the market is at an all-time high, makes no sense. Normally, like I said earlier, you want these groups to be supporting as you're moving up. Well, at this high, they weren't. And so as I drag this through, look at how things turn as the market goes down. I mean, all of these groups, every one of them weaken, and most of them move all the way over onto the left side of the chart. And the left side of the chart is poor relative strength. The bottom half is poor momentum. So you really don't want to be in this group, or in this quadrant. And that's where most of this group found itself until we got to the first March, that first bottom in March. I think it was March 13th. So this is, let me see, let me show you March 13th. So there's March 13th right there. So that was the first bottom. Now, when we get to the second bottom in April, where I started talking about manipulation, I mean, as you get in here, right, as you go through this bottom and all the way out to about April 8th, well, now I'm at the 15th, but I'm going to keep going and just so you can kind of see this. I mean, now we're still well away from the top where we are now, but you can already see all of these groups moving back in northeasterly fashion, supporting this rally in the market. And I'm just going to fast forward here. Now look at where everything is. This was as of May 19th. This was a couple of days ago. Every one of these groups now on the right side showing relative strength. Not that they're going up, but that they're going up faster than the S&P 500. And let me actually just pull this over, get to where we are right now. That's where we are right now. Only specialized consumer services. That's the only group that right now has moved back over into the lagging quadrant. 11 of these 12 groups are on the right side, showing relative strength. And a lot of times what you'll do is when you get a little bit of a sell-off like we're getting right now, you'll move back down into a weakening because most stocks leading the market to the upside are the ones that take the hit to the downside. And then they'll rotate right back up again. So it's going to be interesting to see if that's how this plays out. If I'm right, and we do just go back for a temporary move back to gap support or the 20-day moving average, and then we start to turn back up again, this will be an important RRG chart to follow to see if the leading groups turn back up again and show leadership again. That's what I'll be looking for. But in the meantime, if you're looking for individual stocks, this pullback, in my opinion, is one where we could look for stocks in, leading stocks within these groups that have pulled back. And I'll go over that in just a minute and show you how I do that. First, just want to mention over at Earnings Beats, if you go to earningsbeats.com, both words are plural, Earnings Beats, and scroll down, we have a free newsletter. Comes out Monday and Wednesday. Name and email address is all it takes. There's no credit card required, so you can unsubscribe at any time. That's completely up to you. We try to make this as educational as possible, focusing on the things that are really important to us in the market. So make sure you go over to earningsbeats.com, check this out. Again, it's a free newsletter, and we don't sell email addresses to third parties. You're not going to get spammed by anyone other than us. We might spam you from time to time. Just see if you take us up on our free trial to our paid service, which is 30 days free. You do have to provide credit card for that, but then you'll get to experience everything we do at Earnings Beats. So check that page out. Go to our homepage at earningsbeats.com and join us. Become a bigger part of our community. All right, let's get over here and take a look. This was the aerospace group that I was talking about, and here is the relative strength, but here's the absolute strength, breaking out above that March high. Now we're seeing a little bit of a pullback, so a lot of these stocks that are very stretched will start looking a little bit more appetizing as they get closer and closer to key areas of support, like the rising 20-day moving average. So what did I do? How do I do this? How do I go from here to maybe putting together a watch list? Well, you can go through all the stocks individually in all these groups, which would take you probably between now and next week. Maybe, if I did that, I could tell you the results next Wednesday or Thursday when we do the recording. But instead, I just use the power of the scan engine at Stockcharts, which is a really cool feature if you're a paying member at Stockcharts. These are the 12 groups, and what you do is you just hit new scan. If you hit new scan, you can go down here under the sectors and industries, and like for aerospace, you just go down here under industrials, and there's aerospace. You click on it and then hit that add button, and it'll come up here. Now, once I've done all of that, then I put double brackets at the beginning, double brackets at the end of these 12 industry groups, and it comes up automatically as and between all these groups. I change it to or, because within these 12 groups, if it's and, you're looking for stocks that are in the aerospace group and in the semiconductor group and in the software. No stocks in all those groups. You're going to come up with zero. So you got to switch this to or, so it can be in any of these groups. Then I go down and I take from earnings beats, two of our flagship chart lists, watch lists, if you will, which are strong earnings. There's like 500 companies in that. And then raised guidance, companies that have raised guidance in the last quarter. There's probably 350 stocks in there. And we essentially say, all right, give me all the stocks that are in any of these 12 groups and also are in either of these two chart lists or watch lists. And then give me only the stocks with a scooter score above 90. That's the Stockcharts technical rank. That's a relative strength indicator. So this is how you put it together. You run the scan, and I put it into a list. I just have a numbering system, and there were 45 of them. I dropped them right in here, and I'm going to give you an update on where they stand today. But you can see all of these stocks. I don't know what the overall market. Let's go back and take a look real quick at the S&P. I just want to see where we are. So right now the S&P is up 11 points, which is 0.2%. Look at where all these stocks are. 11%, 7, 6, 6, 4, 4, 3. I mean, you got to go down quite a ways in this list to get down to 0.2, which is right here. So starting from here down, what is it? Maybe 12 stocks are underperforming the S&P 500, and hardly anything by much. I mean, the worst performing stock in this list today is NetEase, which is down just under 1%. So of the 45 stocks today, none of them are down more than 0.97%. And 33 of them are outperforming the S&P 500. Only 12 are underperforming. So this is a great list to pick from. And if you go through and you take a look at, say, let me put in here the sectors and industries. I mean, look at what's leading right here. Software, a lot of software stocks. Software is on fire right now. And so it's handing you great stocks to trade. And then it's simply going in and pulling a stock up like Snow, which is making a breakout today. I think they reported earnings last night and beat estimates, and the stock responded by breaking out to a new high, 52-week high. So that's one that obviously you'd want to be aware of. Great volume, breaking out. I think this is a stock that could start to run a little bit more from here. STNE, that's the StoneCo. That's another software stock. Look at this stock, came down just a little bit below its 20-day, did not go back down to gap support, and has just absolutely exploded back above the 20-day, and is not too far from reaching its high that it set back at the end of April. So another really good looking chart bouncing off the 20-day. Let's see, thread up. This is one of the more aggressive stocks out there. Just keeps going higher and higher. But again, this is one of those stocks that, it's a leading stock in a leading group. So if you pull up the relative chart here, First of all, there's your AD line, which is strong. Price action, obviously very strong. And then you want to see stocks that are in or leading their group. This is specialty retailers. So ThredUp is obviously outperforming the group. And here's the group outperforming the S&P 500. So when you're trying to beat the S&P 500, wouldn't you want to do it with stocks that are going up, beating their peers, and their peers are beating the S&P 500? To me, it seems like a no-brainer. And the AD line, by the way, also going up. So that's, how I would quickly put together a list. And if you go back and look at the list, I mean, again, Snowflake, Digital Turbine starting to regain a lot of strength, APPS, Celestica, one of my favorite stocks in the market, having up 4% today. Palantir, can't, kill that one. Pulled back a little bit recently, but now it seems to be gaining some strength, maybe heading back to another all-time high. CrowdStrike, Carvana. I mean, some stocks maybe you're not familiar with as much. Stock like Laser. This is Knight. Boom. I mean, again, it was 2 weeks ago that it gapped up, and look at it, it's just continuing to move, probably likely heading for that 1470, 1475 area, maybe to a new 52-week high. AD line has just exploded. The stock has exploded relative to its peers with much more significant volume. And semiconductors, I pointed this one out. This one's not sitting at a 52-week high relative to the S&P, but once it started to break this downtrend line and turn up at the beginning of May, I mentioned it because this group moves fast, and you want to be in it when it's making that move. Anyhow, that's essentially what I have for today. So just trade smarter out there. Pay attention to the overall market, the uptrend that's taken place. I know that a lot of folks very nervous, thinking we're going back down to the lows that we saw in April, early April. I am not among those folks. I do not think we're going back down to that level. Could things change? Of course. And if they change, I'll change with them. But right now, everything I'm seeing on the chart says prices are going higher. And so that's the way I'm trading it. Have a great day, everybody. And I will see you next week. Happy trading.